Cryptocurrency has lost a ton of value since 2021. Certain products have been basically wiped out entirely, and others have lost more than half their value from their all-time highs last year. So you might be wondering what to do in a situation like this. Today, we're going to talk about how to handle cryptocurrency in a down market. Before we get started, I want to remind you that I'm not a financial advisor and this is not personalized financial advice. But basically, you have three options in a down market. One is remain an active investor. Stay in the market, try to buy things at lower prices and hope that they go up. Second is keep what you have, stand pat, and keep the faith in the products that you've invested in before and hope they have long-term value. And the last is get out. Lose faith in the market and try to put your money to better use somewhere else. Those are all legitimate options, but in general, there are a handful of rules for investing in a bear market. And they do hold true for crypto, but with some caveats that I'm going to take you through. So there are basically 4 rules for investing in a bear market. Rule number 1 is make dollar cost averaging your friend. Rule number 2 is diversify your investments. Rule number 3 is choose established products. And rule number 4 is focus on the long term. Whether you're buying, selling, or standing pat, you're still going to want to think about these 4 rules. So let's just go through them one by one and think about how they apply to crypto. First is dollar cost averaging. I don't want to get into a ton of detail on this one because we had a whole video about that and you should definitely check that one out. But here we're going to talk about how it applies to crypto. So dollar cost averaging basically means that you're setting a scheduled buy or sell of whatever it is that you are interested in transacting in. So essentially you're not putting all your eggs in one basket of this is the price at which I want to buy and sell. So say you buy or sell once a week, you're going to have a more even price and you're not going to have to think about timing the market. Now, whether you're going to continue to buy or you want to start selling, you probably want to time your sales or purchases around a specific cadence so you know that you're not getting caught on the day where it's at its highest or at its lowest. So diversification. Now this is one where crypto deserves a little extra thought. So diversification basically means you're trying to get a nice set of investments that are not vulnerable to the same risk factors. So if you invest everything in one company, one sector, one cryptocurrency, if something specific happens that causes the value to decline, you're going to lose a lot of money. Now, if you have a lot of different investments that have different characteristics, you're less likely to have one factor wipe you out. But with stocks, diversification is really well established, right? There are mutual funds, there are index funds that follow well-established companies that you basically know are unlikely to completely collapse in the event of an economic downturn, especially if you invest in a lot of them. In crypto, there are not as many blue chip investments. There may be some, but again, the whole asset class is quite new. So you're going to want to think about which cryptocurrencies are absolutely the least likely to collapse. Now, something that's brand new and hasn't been used by that many people may be less likely to survive. Of course, there may be more upside. In general, it's a good idea to diversify not just in the specific assets you own, but in the sectors you're exposed to. And crypto is, even in the best of times, a risky investment. So you should probably have a portfolio that's got exposure to a lot of asset classes, and crypto is a small part of that you're hoping will provide good returns, but won't wipe you out if you don't get those. Now, let's just say you're stuck in crypto, you bought a lot, and you are trying to figure out what to do with your portfolio in crypto. You should still be diversified even within crypto, so you don't want the factors that affect one coin to cause your whole crypto portfolio to collapse or your entire portfolio to collapse. That said, diversifying crypto is not as easy as it is in the traditional markets like stock market, because in the stock market, there's tons of mutual funds that own a lot of different stocks. There are index funds that follow stock indices that have a long track record and a lot of market analytics that you can look at to get some historical perspective. This brings us to our third rule, which is choosing established products. Now, this is harder in crypto than it is in other asset classes. In stocks, you've got companies that are decades, generations old that have a great track record. You have companies that have made mutual funds that have given you exposure to companies that have different profiles and are going to give you different results in different economic conditions, including in recessions or bear markets. In crypto, you really don't have that. In fact, you really don't even have particularly established blue chip projects. You've got Bitcoin, Ethereum, those are the two biggest, and they do have a track record. And there are others that are being used in products that people now count on. And you might want to look at those products as places to put your money when you're trying to weather a recession. Now, that doesn't mean that you can't pick a new product and hope it takes off, because there's always upside opportunities in less established product. But the reason there's upside is because there's also a lot of downside. So remember that diversification we talked about. Now, there are even some people who believe that Bitcoin basically determines the price of other cryptocurrencies. It's so important to the market. Not everyone thinks that, and again, generally diversification is a good idea. If you're looking to build a portfolio of cryptocurrencies in a down market, one idea is to look at usage data. Now, if you go to the official website of any particular cryptocurrency, you can see stats like daily active wallets or daily active users, the amount of transactions that they're supporting on a daily basis. Are these things going up or down? Are they higher than they used to be? Are they higher than they were last year? These are things that might tell you that this is a product that people are using to build things that might create demand for that cryptocurrency going forward. All right, so the fourth rule is you're investing for the long term. Now, just in general, you probably ought to be investing money that you don't need for several years. This is money that you hope will grow over time. That's the general idea behind investing. If you need the money right away, you probably should put it in something more liquid that you can have a good level of confidence that it'll be worth what you expect it to at a certain time. Say you're investing for the long term. This is where it comes back to these three categories of crypto explorers that we discussed at the beginning. One is the person who wants to buy, right? So this is a time when things are cheaper than they were before. Almost nothing is cheaper than it was before right now. Crypto is one of the things that is. So if you believe that crypto or a specific crypto is going to go up long term, this would be a great time to buy it because it's lower than it was before probably. If you're someone who just wants to stand pat, that's another perspective, right? You may believe that long term, what you bought will retain its value and that you can ultimately recoup the losses you faced in the year, right? How much does it really matter that it's down now if you weren't planning to sell it anyway? It's just on paper at the moment. And the last category is the person who doesn't believe in crypto anymore, wants to sell, wants to get out. And there's, a couple of reasons you might want to get out. You might want to get out because the economic circumstances have changed and you need money that you thought you had to invest. There's no shame in that. It's not long-term investing, but you have to do what you have to do with your money. Now, if you want to get out of crypto because you don't believe it holds long-term value anymore, that's another perspective. And certainly there are people who believe that. There's been a lot of drama in crypto over the last year, and that's maybe a little more understandable in crypto than it would be in a more established asset class. If you're going to hold crypto for the long term and you're not going to do much with your portfolio, please remember that it's very hard to recover cryptocurrency if you lose what is called your keys to your crypto wallet. Crypto can be locked away. You can know exactly where it is, basically, and never be able to use it or spend it. And every time crypto goes up in value, there are these horror stories about people who were trying to remember what they had owned and cannot access it, lost out thousands of dollars or more. So make sure you pick a crypto wallet that you feel comfortable with, you pick a storage solution that you feel comfortable with, and you remember your methods of accessing it. If you lose access to your crypto, it may not ever come back, and you've basically thrown your whole investment away. To tie it all up, just remember that investing in crypto in a bear market is not so different from investing in any other kind of asset class in a bear market. The one caveat you have to keep in mind is that there is not as much historical data in how crypto performs. The products that crypto supports are not as established as those that are supported by the companies that issue stock. So that means that you are going to have to trust your gut in the same way you probably did when you bought cryptocurrency about what crypto will do in the future. If you believe it will go up, stay even, or go down, that's going to determine your perspective, and you have to basically make that decision for yourself. I'm Andy Rosen, an investing writer for NerdWallet. If you want to learn more about bear market investing, we have a great video which covers dollar cost averaging, which we discussed a little bit. If you really want to understand how it works, I really recommend you check that video out. And you can check out a lot of other cool videos on our YouTube channel. So if you learned something today, please like and subscribe.